Thank you guys for joining the lecture today. So today we are covering IS 36 impairment of assets. So based on that standard, the objective of IS 36 is to make sure that the entity's assets are carried at no more than their recoverable amount. And their recoverable amount, basically, you see as we go along, it's actually the fair value less cost to sell and also the value in use. So it's the higher of the two. So that's the objective of the standard. And then IS 36 defines when an asset is impaired and how to recognize an impairment loss, when an entity should reverse this loss, and what information related to impairment should be in the financial statements. So also what you need to know the scope of the standard. Basically, the standard scope in and scope out of IS 36 impairment of assets. So there are standards that are scoped in IS 36, and then there are standards that are scoped out. You'll see when I go in here, when I go through these notes, that there will be standards that actually, when you impair assets, you don't revert to IS 36. They've got their own standard. So just pay attention for that. So property, plant, and equipment, for example, IS 16, which we have gone through under 3702, it is scoped in assets such as land, buildings, machinery, credited cost or revalued amount, investment property credited cost model. Remember, the impairment that is carried at the fair value model, it's not scoped in the standard. Intangible assets, goodwill, subsidiaries, associates, and joint ventures at cost. I'm not quite sure whether at your level you have yet covered subsidiaries, associates, and joint ventures, but I've just included them here so that you are aware that I actually scoped in terms of this standards. Standards that are scoped out, meaning that when you do impairment, you wouldn't consider those items within those standards to be falling within the standard, would be inventories, IS2, financial assets, IFRS 9, deferred tax, IS12, employee benefits, IS 19, construction contracts, which is IS 11, investment property at fair value, as I've mentioned earlier, is scoped out, agricultural assets at fair value, scoped out, insurance contracts are also scoped out, non-current assets held for sale are scoped out. So those standards, when you impair, should it happen that because those standards, they've got their own criteria when assets, for example, such assets such as the ones which are created fair value, already they say that the impairment factor is taken into account when you measure it at fair value. So the fair value, because it goes up and down, so that is taken into account. So that's the scope of this IS 36. But also what you need to know is that when you need to ask yourself a question as to when will an asset be impaired? And the asset is impaired when the carrying amount in the accounting records is greater than the recoverable amount. So if the carrying amount is greater than the recoverable amount, you then gonna have to bring back the carrying amount of an asset to its recoverable amount. So that difference there is called an impairment, and then you're gonna recognize it to profit and loss. Fair value less cost to sell or value in use. So basically, just put them in brackets so that you know that is actually the fair value less cost to sell. The higher of the two you will take as a recoverable amount. Also, what you need to know is that you need to be able to identify assets that might be impaired in terms of this IS 36, and also assess whether there is an indication that an asset might be impaired at reporting date. If no indication, no impairment to be performed. When holding an intangible assets with indefinite life, trademarks, for example, and you remember the other time what I've made an example of a servitudes, which are indefinite in terms of their life, or intangible asset not yet available for use, test for impairment annually. So these will test them for impairment annually. Goodwill acquired in a business combination must be tested annually for impairment as well. So that's what you actually need to know in terms of the standard. So another thing also what they've mentioned on the standard is that there are indicators of impairment. If you go read through the standard, you'll see that there's where they show you that there's indicators for impairment to guide you in terms of whether the asset is impaired or not. So these indicators might be externally or internally. External sources of information would include, for example, observable indication that the asset's value has declined during the period, significantly more than would be expected as a result of passage of time or normal use. Significant changes with an adverse effect on the entity in the technological, market, economic, or legal environment in which the entity operates, or in the market to which the asset is being dedicated. Market interest rates or other market rates of return on investment have increased during the period, and those increases are likely to affect the discount rate used in calculating an asset's value in use, or decrease the asset's recoverable amount materially. So in that case, for example, you know that within an organization, entities have got what we call WACC. I don't know whether you've done that. It's called a weighted average cost of capital. Weighted average cost of capital takes into account different interest rates. You'll have cost of equity, you'll have cost of borrowings. So for example, if the cost of borrowings have gone up, right, it will impact the overall weighted average cost of capital. Meaning that when you now have to calculate the current value or the value in use, where you have to discount cash flows to present value, the value in use might go down, might be lower than the carrying amount. So in that case, you might have an indication of impairment. It doesn't mean that the assets are impaired, but it might be an indication that an asset might be impaired. So you might have to go through that exercise to calculate what is the value in use for that asset using weighted average cost of capital to discount the cash flows. Also, the current amount of the net assets of the entity is higher than its capitalization, right? Market capitalization. So what do they mean, guys, when they say the current amount of the net assets of the entity is higher than its market capitalization? In this case, when, for example, you take all the total value of all your assets, like in the balance sheet, you subtract all your total liabilities in the balance sheet, you get what we call net assets, which is equivalent to equity, right? So that amount, if it's higher than the market capitalization, I've put this in brackets because I know some of you might not know what do they mean by market capitalization. Market capitalization, guys, if a company is listed on the Johannesburg Stock Exchange, the only thing you do, you look at their annual financial statements, you check what is their number of shares issued to date, right? Then you take those number of shares issued to date, you multiply it by the current share price of that company. It will give you the market capitalization of that company. So that amount that you get when you compare it to the net asset value, meaning that the total assets minus total liabilities. If the total assets minus total liabilities is higher than this market capitalization, already you can see that probably some of the assets here might be impaired. Because remember, the net assets value is the remainder of the total assets. Because once you have subtracted the liabilities, it's a remainder of the assets. So the value thereof, if it's higher than the market capitalization, it's an indicator that actually this asset might be impaired, or some of the assets in the balance sheet might be impaired. So these are the external factors that you need to take into account. What I didn't actually, guys, let's just go back. There are other factors. Remember these factors that I've listed here that are external, which might actually impact the assets, the assessment of whether the asset is impaired or not. They are not limited here. There are a lot of factors. Like you've seen what is happening now in South Africa, where we have, I don't know, political situation or whatever. So those things also, remember those shops that were destroyed. Remember the buildings that were burned and all that. All these things are actually signs of impairment. Actually, those buildings, let me say, are impaired because they were damaged, you know. So there are a lot of factors that actually can affect the assets, the entity's assets in terms of whether they are impaired or not. So external factors also, maybe if some of the assets that you have, I don't know, they are impacted by international, I can't come up with an example. They're impacted by international news or whatever. And then also you might have to consider that for impairment, you know. And maybe I will think of examples, I'll give you examples. So there are a lot of factors. And the reason why I'm going in detail with regard to this is that in the exam condition, you should be able to identify those factors of whether the assets are impaired, because they will probably write type a scenario for you. When you read, you must be able to identify with, okay, here you might have an economic or legal environment or whatsoever, or indicator of impairment. So we also have internal sources of information. Now that you have spoken about external sources, we have internal sources of information. An example will be when an asset is obsolete or physically damaged. So in that case, you might need to look at it for impairment. When I was in audit, I've looked at, for example, for municipalities, you find that when there's a strike, people burn buildings. For example, if the building is partially burned, we will just impair that portion that is burned, and then we'll bring in the expert to look at the extent of the impairment. Then we'll impair that portion. Once it is repaired, it's fully recovered, then we'll reverse that impairment. So that's another example that I can think of for now. Significant changes with an adverse effect on the entity related to the use of an asset. For example, an asset becoming idle, you know. So like, for example, with municipalities that I was auditing, for example, you'll see work in progress. Work in progress, if let's say they are building a reservoir, now the work has stopped, you see. So normally we'll have audit procedures to address impairment, because those assets that are idling around there, they might actually result in impairment. So you might have to assess and look at whether the work in progress that is not being finished, meaning the reservoir, there could be some parts there that you might need to impair. Also plans to discontinue or restructure the operation, so to which an asset belongs, plans or to dispose of an asset before the previously expected date, and reassessing the useful life of an asset as finite rather than indefinite. So these are things that you might have to look at for indication for impairment. Evidence is available from internal reporting that indicates that the economic performance of an asset is or will be worse than expected. So maybe the asset is no longer performing the way it is expected. It's constantly being repaired, even though, let's say, it's repaired, but it's still not functioning well. So that in itself, it might be an indicator to say that maybe you need to revisit the carrying amount of that asset because it's depleting. So also in that case, you might actually need to impair that asset. So now that we have gone through the impairment indicators, remember guys, these examples that I've mentioned here, they are not exhaustive. You still need to, there are a lot of factors actually that are there that might result in an asset being impaired. So also, now what we have done, we went through the objective, meaning that we've gone through the objective to say that the objective of the IS36 is to make sure that entities' assets are carried at no more than their recoverable amount. So if the carrying amount is more than its recoverable amount, being the value in use or fair value less cost to sell, we must then impair that asset. Also, we went through the scope. So what you need to know within the scope is that which standards are actually scoped in or scoped out of this of IS36. So I've listed those standards that are scoped in and those ones that are scoped out. So that is also important, because in the exam they can trick you and say, for example, financial assets are impaired. Would you impair them in terms of IS36? So If you say that, then you have applied the principle incorrectly, because you then you probably should have known that actually it's scoped out of IS36. So what we have also done, we've gone through the question of when the asset is impaired, and then we've indicated that its carrying amount in the accounting records is greater than the recoverable amount. Then you'll have to impair the recoverable amount, being the fair value less cost to sell or value in use. Identification, also we've gone through the identification of assets that might be impaired. Yeah, so we indicated that assess whether there is indication that an asset might be impaired, and the indication is based on these factors that we have discussed here below, and then also intangible assets with indefinite life, and also goodwill. You need to look at that for impairment annually. So these are the things you need to know. And then we've gone through the indicators. I've made some examples. So bear in mind. So now the recoverable amount. Recoverable amount is defined as follows. The recoverable amount of an asset is the hire of an asset or cash generating unit, fair value less cost to sell. Fair value less cost of disposal, and its value in use. So it's the higher of the two. So if they've given you two values, meaning the fair value less cost of disposal versus the value in use, you check which one is the higher, and then you take that one as the recoverable amount. No need to determine both amounts, because if just one of them is higher than assets carrying amount, then there is no impairment, right? So if let's say in the exam scenario, they've given you information, and then you realize that actually one of the recoverable amount, either the value in use or the fair value less cost to sell, is basically higher than the carrying amount, there is no need to do impairment, because remember, is the higher of the two. So obviously, if you don't know the other one, the chances are that if it's lower or it's higher, it won't make a difference, because anyway, you're going to take the higher value. That's why they are saying here, no need to determine both amounts, because if just one of them is higher than the assets carrying amount, then there is no impairment. The only problem comes when it is lower. You might have to then determine the other one and see which one is the higher. Then you will impair based on that. When an individual asset does not generate cash inflows that are largely independent of those from other assets or group of assets, then you need to determine the recoverable amount of the CGU, of the CGU or the cash generating unit to which that asset belongs. I'll make an example, guys. Don't worry. I've done my own example of the CGU. Then you'll see what they are basically. What do they mean here by this statement when they are saying when an individual asset does not generate cash inflows? Because remember, if an individual asset does not generate cash inflows, how are you going to determine the value in use, for example? Because for you to determine the value in use, you need to be able to know what is the cash inflows and outflows. Then obviously you'll discount the net difference to get the present value of meaning being the value in use. Also, if that asset does not generate cash inflows that are largely independent of those from other assets, you can't even determine the fair value of that asset, in the cost of disposal. So that's why they say for that individual asset, you must look for the other group of assets that are generating cash flows that are independent. Then you'll add that asset, then you impair the whole cash generating unit. Fair value less cost of disposal. For fair value less cost, we're still going to do IFRS 13. So for that fair value, for the fair value concept, just refer to that standard. But we're still going to do that, so you'll learn more about that. And then cost of disposals are, for example, legal costs, stamp duties, similar transaction taxes, cost of removing the asset, and direct incremental cost to bring an asset into its condition for its sale. So that's what you need to know in as far as fair value less cost of disposal is concerned. And value in use. Value in use is the present value of the future cash flows. And future cash flows, I mean inflows and outflows. expected to be derived from an asset or a cash generating unit. To determine the value in use, the following elements must be taken into account. So for you to be able to determine the value in use, you must take the following into account: an estimate of future cash flows the entity expects to derive from the asset, expectation about possible variation in the amount or timing of those future cash flows. That would also include the discount rate, the time value of money represented by the current market risk-free rate of interest. And the risk-free rate of interest, it refers to the government bonds. So this would be the risk-free rate of interest. The price for bearing, the uncertainty inherent in the asset. Other factors such as illiquidity that market participants would reflect in pricing the future cash flows the entity expect to derive from the asset. So these are the factors for value in use that you need to determine. I'm not quite sure if in the exam you might get a situation where you might need to calculate the value in use. But if it happens that you calculate the value in use, just be able to identify the cash inflows and outflows, and also the other variables such as the discount rate that you might need to use. Normally, most of the time, they will give you that value in the exam condition. But also, you need to know the principles or the theory behind the value in use. And then also recognizing and measuring an impairment loss. If the asset's carrying amount is lower, if the asset's recoverable amount is lower than its carrying amount, then an entity must recognize an impairment loss as the difference between these two amounts. An impairment loss shall be recognized to profit and loss, or as a revaluation decrease if the asset is carried at revalued amount in line with other IFRS. So for example, if you have a property, plant and equipment that you revalued, so when you impair, you must first, if there's an impairment, you must first hit the revaluation surplus. If it's depleted, then the difference will go to the profit and loss. So basically what I did here is the formula: impairment loss is the carrying amount minus the recoverable amount, because the carrying amount is higher than the recoverable amount. Under the cost model, debit goes to profit and loss, impairment loss, and then the credit goes to the asset adjustment, right? And then the revaluation model, debit goes to OCI, revaluation surplus, or profit and loss, impairment loss. If let's say the revaluation surplus was depleted, then the remainder of the impairment will go through to the impairment loss. Credit goes to the asset. It's the same thing as the one under cost model. And then also the depreciation should be adjusted in the future periods in order to reflect the asset's new carrying amount. The reason why you will adjust depreciation, because now remember, in terms of the carrying, because now you the time span, the lifespan of an asset has changed, because that's an indicator. When you impair an asset, it means the benefits that you're expecting to get from the assets, if they have reduced, the chances are that even its period from which you expect to obtain the benefits would have changed as well. So you also need to reassess what is actually the real remaining useful life of that asset. So you'll probably have to also revisit that. And that change that you have made would have been the change in estimate, obviously, from what we have learned yesterday. So now, guys, we've covered basically the impairment. So now there's another elephant in the room that is called cash generating units. I remember when I was at varsity, we used to learn about cash generating units, but I didn't know what is actually a cash generating unit. Even though the definition was actually explicit to say what is it, but I kept on imagining what is this cash generating unit they are talking about. Because most of the time we didn't have examples of exactly what is cash generating unit up until you go to the exam. Then that's when they'll throw you with a cash generating unit. Then you become so confused. So basically, based on the definition, they are saying a cash generating unit is the smallest identifiable group of assets that generate cash inflows that are largely independent of the cash inflows from other assets or group of assets. Let me go through the definition again. They are saying a cash generating unit is the smallest identifiable group of assets that generate cash inflows that are largely independent of the cash inflows from other assets or group of assets. So I'll make an example. If you have what do you call it? A pizza business, which one? Debonair's, right? Basically for Debonair's, we are using ovens to bake the pizza. So the Debonair's, that unit is called a cash generating unit because the oven that you are using to sell pizza is generating cash inflows to the business, right? Obviously, you will have also expenses, but the assets within the pizza business, your oven and all of that, they are there to assist the business to generate cash flow. So in that case, let's say you want to impair an oven, you will impair probably the whole cash generating unit, meaning that the pizza unit, because it's a cash generating unit in itself.
Oh yes, sir. I wanted to ask based on the standards that you were showing us. There was one point where you said that they might ask us maybe in a situation and ask us which standard is that. Then maybe you answer wrong and say standard 36, IAS 36. So I wanted to know that for exam purposes, are we supposed to know which standard falls under which situation falls under which standard? Will they give us a scenario where we have to identify what standard applies to that particular information that is given?
Oh, I see your question. Well, let me just go back there. Basically, yeah, it's under the scope. I think you're referring under the scope, right, Spongin?
Yes.
No, it might not be. It might not come in a form of the question, but this will also assist you in terms of knowing which standards are scoped in IS 36. I'll make an example. Let me see. I'll make an example. Let's say
Yes.
you have a list of assets. They say you must impair them. One of those assets is investment property, right?
Yes. Yes.
No, an investment property, remember, it can be a building.
Yes.
It's actually a building, not it can be a building. It's actually a building, right? And then they're saying to you, also what they've given you, not only the building, they've given you machinery in there, they've given you vehicles in there, they've given you all other sorts of assets that are there. Then they are saying to you, you must impair these assets, right? And then they are telling you that this building is actually an investment property and you are carrying it at fair value, right?
Yes.
Then, if in the exam condition, you don't know that actually investment property that are at fair value are special. You see what mistake you're gonna do? You're gonna impair that building under IS 36. You see that? Because you don't know actually scope. Then you're not gonna get the principle correct. That's what I was trying to show you. You understand? Yeah?
Yes.
Yeah, so all I'm trying to say is that please know which ones are scoped in and which ones are scoped out. Because you can see already investment property at fair value, not scoped in. So I'm giving you an example in the exam scenario to say that I'm giving you a list of assets, but within that list of assets, you have investment property, which is a building, carried at fair value. And remember in the exam, they're not going to tell you that it's scoped out. They're just going to be silent. You see? And then let's say you start impairing. Then when you start impairing, you're gonna, let's say you impair everything. You even impair the investment property at fair value. You would have gotten the principle incorrectly because you should know that investment property is scoped out of IS 36. So you shouldn't impair. So,
okay, so let's say,
yeah.
Yes, let's say I did what you just said. I impaired the right ones and the wrong ones, the one that are scooped in and the one that are scooped out. Will that automatically make the whole question wrong, or will they mark the ones that are correct?
No, actually they will mark you based on okay, I'll make an example to the university that I used to attend. They were very harsh for us. Like what they used to do at VETS, they used to penalize us for applying the principle incorrectly. You see, for example, let's say you impair both. You impair the ones that are scoped in and the ones that are scoped out. What they used to do, they used to minus marks for you. You see, but UNISA might be different. they used to penalize us for applying the applying the principle incorrectly. So they will say to you, -1 mark for applying the principle incorrectly, and then they will explain to you that investment property carried at fair value is scoped out of IS36. You should have identified that in the exam, but you didn't. So that's why we minus these marks, you see. So universities are different, but all I'm trying to say to you is that it will help you to be able to remember which ones are scoped in, which ones are scoped out, so that in the exam you don't make a mistake. In as far as your question to say that, will you be able to carry the marks? You will be able to get the marks, even though obviously then your amounts might be wrong. You see, your amounts might be wrong because you apply the principle incorrectly. You'll get what they used to use the word called carrying on marks or something like that. So even though you were wrong, but going forward, let's say you've applied the impairment correctly, you carried it through to the profit and loss, you'll get those marks even though the amount is wrong. You see, because at least you know the principle that impairment goes to profit and loss and all. So I don't think you'll be penalized overall to say you don't get marks at all. They will penalize you at one point, but going forward, you'll get all the marks.
Okay, so can I ask the last question, sir?
Yeah.
Based on investment property, when we have to do the PPE note, and let's say maybe we're given 3 properties and one of them is investment property, I just want to clarify something. Are we including that investment property as part of the note, or we don't disclose it in the PPE note?
No. Remember, even if it's an investment property, it's still part of the note. But instead of saying PPE, you're gonna say investment property. So you're gonna disclose it separately as investment property. So what you're gonna have the cost, and then also the adjustment being your fair value if you have revalued it. I mean, you have fair valued it, and then the carrying amount at the end. You see, but separately from PPE. You're going to have another line item called investment property.
Separately from PPE, I don't understand you there, sir. Are you saying we're going to have a column separately for investment property? Or, because I remember on my assignment, sorry to mix up the...
No problem.
To mess up the class. I remember in my assignment, we were given 2 properties. So there was property A and property B. Then we had to disclose the PPE note. So on the PPE note, I got penalized because I showed it separately. I didn't know that I had to consolidate everything and then make one PPE note, because I made PPE note for property A and property B. So that's why I'm asking, yes, sir, that's why I'm asking, do we include investment property? Because when I checked the memo, they only indicated the PPE note for property A and property B was not included. So that's why I thought maybe when we given the investment property as well as with other PPE item, we don't really take note of the investment property part.
No, you have to disclose investment property. As I'm saying, it's just maybe I'll come up with an example of the financial statements. I'll show you how they are disclosing it in terms of PPE. Normally, what happens is that when you disclose the PPE, remember in the face of the financial statements, it will be just one line item called property, plant, and equipment, right? But in that property, plant, and equipment, in the face of the balance sheet, you will have in there will be investment property rolling in there. But when you go to the actual note, you will see that they will have property, plant, and equipment. Then at the bottom, they will have investment property, because it's a separate line item to the PPE. Even though under PPE, under the balance sheet, it's called property, plant, and equipment. But in the note, they will separate it and say, on top, there is property, plant, and equipment. Then at the bottom, it's investment property. Because the disclosure is normally different. But I'll bring an example. I'll bring an example so that you can see how the disclosure is done.
Okay, sir. No problem. I'll wait for the example.
Yeah. Maybe if possible, if I can pick up an example now, because I think I have few financials. I'll show you what I mean.
Okay, sir.
So I was saying here, a cash generating unit is the smallest identifiable group of assets that generate cash inflows that are largely independent of the cash inflows from other assets or group of assets. So I've made an example to say that you have a pizza business or a bakery where you bake bread, and then the bread that you are selling, it generates cash inflows. Even though, let's say, the bread is 10 Rand or so, the mere fact that using those the ovens, you are baking bread, the oven being the asset, because in your books, you probably recognize an oven as an asset, right? And then that oven will be an asset that will form part of a cash generating unit. A cash generating unit in this case being the whole business of selling bread or pizza. So that's the example that I can think of, but I have another example that I've reserved for you. You'll see also there what could be another example of a cash generating unit. If you are not able to determine recoverable amount for an individual asset, in this case, for example, for an oven, then you might need to establish cash generating unit to which the asset belongs. In this case, that oven belongs to the whole business of selling pizza or of selling bread. So you will probably include the oven within the whole business and then impair the whole business and then allocate the impairment to individual assets, including that oven. In determining your cash generating unit, you need to be consistent from period to period to include the same asset or type of assets. You need to be consistent in determining the carrying amount of cash generating unit with determining recoverable amount of the unit. It means that you need to include the same assets in calculation of carrying amounts and recoverable amount too. So now at least you have an idea of what they mean by cash generating unit. Because sometimes when you do impairment, you don't do an impairment only for an individual asset. You might do impairment for the whole cash generating unit, being the pizza business. And the way you're going to do the impairment for that pizza business, so now if they say impair the cash generating unit, you'll probably identify the ovens, carrying amount of the oven, carrying amount of the building for that, the building if you are owning the building, carrying amount of the motor vehicles that you are driving, delivering pizza and all of that of the bakery, right? And then you add all those carrying amounts minus all the liabilities. If you have any liabilities, then you get what we call the net asset value. And then from that net asset value, you're gonna compare it to the, you take the net asset value, compare it to the recoverable amount of the whole building, of the whole business. Then it will give you an impairment. Then that impairment, you're gonna proportionate it to all those assets, to impair those assets. You see. So, goodwill, guys, if I may ask you a question, right? The thing is, I just want to gauge at what level are you? Normally, I know when I was at university, we used to do goodwill from third year. Have you guys done goodwill or business combination? Spongile or anyone, if you can guide me, guys, because I just want to see the extent of me explaining. Do you know what is goodwill?
We did it. I think it was second or third year, but I don't remember.
Oh, I see. So you did do a business combination, right?
No, not business combination. We just did goodwill.
Goodwill. All right. Yes. No, it's fine. Okay. But I think it will be best for me to be able to explain what is goodwill. Eh? So if they are saying goodwill, if there is a goodwill acquired in a business combination, you see, normally when you do your fourth year or meaning your postgraduate graduation or whatever courses, or even in your third year, you're supposed to do business combination. Then that's when you're gonna learn the concept of goodwill. If there is a goodwill acquired in a business combination, then it must be allocated to each of the acquirers' cash generating units or group of them that are expected to be benefit from the synergies of the combination. So, guys, what is goodwill actually? I don't know how familiar are you guys with the mall in Israel called Lakeside Mall, right? I don't know how many of you who know that mall, because I think that would be a good example. If you see that mall driving through the freeway coming from, say, Mpumalanga, N12, right? That mall is designed in such a way that it's like a ship, right? When you look at the mall and then you look at the lake, you'll see that it's like a ship. Né? So let's say one day I want to buy that mall, right? The whole of the mall. I want to buy the whole of the mall. And then the expert comes and calculate, or the valuer comes and calculate how much I'll pay for the mall. Let's say overall, for all the assets that are there in the mall, the buildings, the shops, everything, I'm gonna pay, say, 50 million for that mall. But now, the owners of that mall, they are saying to me, no. You can't pay only 50 million because there's synergies or there is that unidentifiable portion where you need to pay for. Like, it's like, what can I call it? There's a word that they use. What's this word called? Where you pay a premium. A premium, you pay a premium because when people are traveling either to Mpumalanga or from Mpumalanga, because of the beauty of the mall, they want to pass by the mall. And if they want to pass by the mall, when they're going inside the mall, they're not gonna just go there buy. So the customer loyalty is there because the area is nice, and because of the beauty of the lake, some come and just chill. They like the mall and all that. So you must pay for that, meaning that you must pay for the beauty of the mall, because the mall is like a ship, it's designed like a ship, so it is very nice, you know. So you must pay, and in addition to the 50 million that I need to pay, I must pay that additional premium. Let's say they add on top of the 50 million that I need to pay, they are adding, they say you need to pay us an extra 10 million, meaning that I'm no longer now acquiring a mall at 50 million, I'm acquiring it at 10 million. At 60 million, in addition to the 50 million. So that extra 10 million that I'm paying for the goodwill. So that's the example that I can think of. And also maybe if you acquire a business, if you're paying extra than the value of that business, it means you're probably paying for something that is special about that business. For example, maybe customer loyalty, there's a lot of customers who come and buy or something like that. That additional, and remember what I said when we did intangibles, that you can't recognize customer loyalty as intangible assets because you can't control customers. So in this case, even though you're gonna pay for that, you can't recognize it per se as a specific asset, but you call it a goodwill. So that's the proper example, guys, I can come up with. I hope I've tried to clarify what exactly is goodwill. So that goodwill in a business combination, what will happen is that in the individual financial statements of the entity that is being acquired, it won't be recognized, but it will be recognized in the group's financial statements, the goodwill, because they would have paid for that additional portion that doesn't relate to either of the assets. It's just the example that I've just done. So each unit to which the goodwill is allocated shall represent the lowest level within the entity at which the goodwill is monitored for internal management purposes, not be larger than an operating segment determined in accordance with IFRS 8 operating segments. Goodwill to be tested for impairment on an annual basis. So now at group level, if you have recognized this goodwill, you need to assess it for impairment at year end. Remember, goodwill, you can't depreciate it, because the reason why you can't depreciate it is because there are some assets that are rolling within that goodwill, of which we can't pinpoint to say what type of assets. I've made an example to say that we have that building there, because of the beauty of the place, you've paid for that. But that beauty thing, you can't tell what type of an asset it is. Hence, it will be rolling inside that goodwill amount. So hence, you can't impair it, because you don't know what type of an asset that is rolling within that goodwill. You can't actually have a clear understanding of what exactly an asset I'm paying for, but you are paying for something, which is a goodwill, an asset. So the only thing you can do is just to impair goodwill at the end. That's the only thing you can do on a yearly basis. Normally, the group will review the goodwill for impairment. A cash generating unit CGU with allocated goodwill shall be tested for impairment at least annually. In this case, testing means to compare the carrying amount of the CGU, including the goodwill, the recoverable amount of the CGU, and then testing of the CGU with goodwill. So you will see there's an example that I've done in as far as this is concerned. So what they are saying is that the carrying amount of the cash generating unit, including the goodwill, and the recoverable amount of that CGU, testing of CGU with goodwill. So you must test overall, including the goodwill for impairment, and then you must first, when you start impairing, you must first impair the goodwill and then the individual assets within that CGU. So also you have what we call corporate assets. Corporate assets are assets other than goodwill that contribute to the future cash flows of both the CGU under review and other CGUs. The examples of corporate assets are headquarters building. Obvious headquarters buildings are administrative buildings, electronic data processing EDP equipment, or research center. Those are corporate assets. You'll see that most of the time when you have a CGU, they might also give you a corporate asset that you must include within the CGU for impairment. When you are testing a CGU, then you should first identify all the corporate assets that relate to the CGU under review, and then include them in the CGU. Then if a portion of the carrying amount of the corporate asset can be allocated to that unit in some reasonable or consistent basis, then you shall compare the carrying amount allocated portion of a corporate asset within with its recoverable amount. If such an allocation is not possible, then you go so-called bottom-up direction. The bottom-up direction is explained below. They are saying you shall test the CGU without corporate asset for impairment first, and then recognize any impairment loss first. That's what you must do. Then identify the smallest group of CGU that includes the CGU under review, and to which a portion of that carrying amount of the corporate asset can be allocated on a reasonable basis. Then compare the carrying amount of that group of CGUs, including the allocated portion of the corporate asset with the recoverable amount of the group of CGU. Then you recognize the impairment. So these are corporate assets. Normally you'll see them in the exam condition. They will throw in some bit of corporate asset there. Then the expectation will be that you will include them in the CGU when you impair. Impairment loss of cash generating unit. If the recoverable amount of CGU is lower than its carrying amount, then an entity shall recognize the impairment loss. If the impairment loss shall be allocated to reduce the carrying amount of the assets of the unit in the following order. Reduce the carrying amount of any goodwill allocated to CGU. Guys, don't worry about this. I have an example you see based on what they are saying here. So they are saying the impairment loss shall be allocated to reduce the carrying amount of the assets of the unit in the following order. First, you reduce the goodwill. You reduce the carrying amount of the goodwill allocated to the CGU. If the impairment is higher than the goodwill, you will hit the whole goodwill, meaning that you impair the whole goodwill. Then the remainder will go to, then you allocate the remainder, allocate remaining impairment loss to the other assets of the unit pro rata on the basis of their carrying amount of each asset in the unit. These reductions are recognized as individual assets. These reductions are recognized impairment losses on individual assets. You see when I make an example. In allocating an impairment loss, you must make sure that you don't reduce the carrying amount of the asset below the highest of its fair value less cost to sell or less cost of disposal, its value in use or zero. You'll see when we make an example. Please see example on the next step. You'll see when I make that example. Basically, the overall thing here, what we're going to be doing in this example, we're going to be impairing the CGU. Then we're going to first hit the goodwill. From goodwill, then we're going to impair. The remainder of the impairment, we're going to hit the other assets on the pro rata basis. Then you'll see what I'm doing. And then also you'll see that in as far as I'm doing that impairment, I'm comparing that impairment to the individual fair value of those assets and value in use to make sure that I'm not impairing to the, I'm not reducing the carrying amount of the asset below its fair value less cost to sell or its value in use. And then also reversal of impairment loss. Here you need to take the same approach as in identifying the impairment loss. You need to assess at the end of each reporting period whether there is an indication that there is an indication. Let me see this. At an impairment loss recognized in prior periods for an asset other than goodwill may no longer exist or may have decreased. I've made an example earlier of a building that they would have been banned due to riot, but not the whole building. Then we come and repair the whole building. Then we brought the building to its original condition. Then whatever that we have impaired in the previous year, we then have to reverse it because now the building is in its good condition. You need to assess the same set of indication from external and internal sources than when assessing the existence of impairment just from the other side. You can reverse an impairment loss only when there is a change in the estimates used to determine the asset's recoverable amount. It means that you cannot reverse an impairment loss due to passage of time or unwinding of the discount. Reversal of impairment loss, individual asset. So if you reverse an impairment loss for an individual asset, you must increase the carrying amount, meaning that when you reverse it, you must increase the carrying amount. But when you increase the carrying amount, it shouldn't be greater. It shouldn't be less than or greater than original carrying amount. So you must limit it to the carrying amount. Profit or loss or revaluation increase, adjust depreciation. And then also cash generating unit. For cash generating unit, let me just go down here. They are saying allocation to assets pro rata, no goodwill. So meaning that previously, if we would have impaired goodwill in full, you cannot come back and reverse the goodwill. You just ignore. But what you'll do, reverse the impairment for the asset that you have impaired. Carrying amount of the asset not to increase to the lower of recoverable amount or original carrying amount. So that's what you need to know. But also go through these notes. Go through the IFRS so that you remember this, because it's important. Reversal of impairment loss for an individual asset. You can reverse an impairment loss only when there is a change in the estimates used to determine the asset's recoverable amount. It means that you cannot reverse an impairment loss. So it's the same thing. It means that you cannot reverse an impairment loss due to passage of time or unwinding of the discount. Reversal of an impairment loss is recognized in the profit and loss unless it relates to a revalued asset. The increased carrying amount due to reversal should not be more than what the depreciated historical cost would have been if the impairment had not been recognized. So basically, guys, what is happening here is that if previously you had impairment, then subsequent year you reverse the impairment, you must also do the calculation for the original carrying amount of the asset, excluding impairment, meaning that you must take the carrying cost minus accumulated depreciation for that asset, excluding impairment. Then when you reverse, make sure that your reversal, when it increases the carrying amount, it's not more than the historical cost of the asset, the depreciated historical cost. So they mean that cost minus accumulated depreciation, excluding impairment. So if it's higher, you limit it to the historical cost. That's what they mean here. So don't forget that, especially most of the time when you do the reversal, make sure that you calculate the carrying amount of the asset reversing with impairment, then you reverse the impairment. But make sure when you reverse the impairment, you limit your reversal to the historical cost of that asset, meaning that the cost minus accumulated depreciation, meaning that the carrying amount, excluding the impairment. Also, you must not forget to adjust the depreciation for future periods to reflect the revised carrying amount. So in this case, obviously, the remaining useful life might have changed. Reversal of impairment loss for a cash generating unit. When you reverse an impairment loss for a cash generating unit, you need to allocate reversal to the assets of the unit, except for goodwill. So meaning that if previously you impaired the goodwill in full, you cannot come back and reverse the impairment of the goodwill. Once you have impaired the goodwill, you have impaired the goodwill. You can't reverse it. Pro rata with the carrying amount of the assets of an asset shall not be increased above the lower. Similarly here, it means if you impair the cash generating unit and then you are reversing the cash generating unit, the carrying amount of an asset shall not be increased above the lower of. So when you increase the carrying amount of those individual assets within the cash generating unit, you shouldn't reverse the impairment to be, so that the carrying amount is the lower of its recoverable amount or the carrying amount that would have been determined net of amortization and depreciation. So it's the historical cost without any prior impairment loss. So it's similar to the one above, except that also you take into account here its recoverable amount. And then reversal of goodwill, what are they saying? The reversal of goodwill, they are saying reversal of impairment loss for goodwill is prohibited. So you can't reverse the goodwill. So basically, guys, that's it for impairment of assets. So what I want to do now, I want to take you through the example that I've done so that we can also do the example that what's her name, Sibongile had asked me to do. But before I move on to the example, are there any questions with regard to these notes? Any questions before I move on to the example for the case generating unit? All right, guys. So let me just quickly go to the example because I see the time is running out of is running away. So let me go move to this example, and then let's do this cash generating unit example, and then what we'll do that example for smart security. So what this is, guys, this is just my example that I've done, so that you have the overall picture. What do they mean by the cash generating unit? So what I'm saying here is that an entity Y purchase entity 100% of entity X with the following details, and at the date of purchase had paid 1.2 million for the total acquisition of entity X. So entity X is classified as a cash generating unit because it can generate cash inflows that are largely independent of the cash inflows from other assets. Sorry, my definition I think is wrong here. An entity X is classified as a cash generating unit because it can generate cash inflows that are largely independent of the cash inflows from other assets. Yeah, that's correct, or group of assets. So that's why they are saying entity X is a cash generating unit. So entities X assets in the statement of financial position or balance sheet at the date of purchase by entity Y were as follows. So entity X had machinery at the date of purchase with a carrying amount of 300,000. They had intangible assets with a carrying amount of 200,000. And remember, guys, I've made this example deliberately. This is what you can actually also get in the exam. If you remember the question you asked me earlier, you'll see when I do here, when I do my example, that some of the things might be scoped out. So you need to remember that. So I brought those things here just deliberately so that you guys don't forget which ones is scoped in terms of IFRS, in terms of IS36, which ones are scoped out. So, for example, machinery is scoped in intangible assets, motor vehicle, truck, inventories, receivables, trade, and other payables. In this case, they are owing suppliers, right? And then you see, you remember what I told you, what is a net asset value? The net asset value is basically the assets, all my assets, right, minus my liabilities. So I got the net asset value. So the carrying amount of the cash generating unit in this case is this net asset value. So as at the date of acquisition, this net asset value was 800,000, 820,000, right? So calculating goodwill. So now, based on this, if we have paid, if the net, we are acquiring a business of which the net asset value is 820, but we are paying 1.2. Does this make sense? You see, you are paying a premium here, and that premium is 338 million, right? 380 million. I mean, sorry, it's 380,000. So what does that mean? It means there's something that we are paying that is special about this business. It could be customer loyalty. It could be we are paying so much because it's in an area where it's got a lot of customers. You see, so for that part where where I'm saying it's got a lot of customers, we can't really recognize that as an asset, but somehow we are paying for that in a form of a premium. Then we call that a goodwill. You see, so our goodwill now is 380,000. So I've also given you the recoverable amount of this cash generating unit, which is the higher of the value in use of 600,000 and the fair value loss cost to sell or cost of disposal, right? So this is how much you have. So the higher is there. So this is my recoverable amount. So now I must impair. So calculating impairment, what I've done, I took the net asset value of the CGU 820, right? Then I took goodwill, I've added goodwill. They are saying you must add goodwill within the cash generating unit. So I'm getting 1.2 million total value of the whole business, right? What is my recoverable amount now? My recoverable amount is actually less than the carrying amount of the overall business. So my recoverable amount is 700,000. So it means now I have an impairment of 500,000. Now that I have an impairment of 500,000, I must deal with this impairment. And how do I deal with it? Based on what the standard is saying. You remember the standard says, let me just go there. It says, there's that part that was talking about the allocation. I just want to show you. When you do the impairment of the cash generating. You see, they are saying if the recoverable amount of the CGU is lower than its carrying amount, in that case it was 700,000, was less than the 1.2 million, then the entity shall recognize the impairment loss we've recognized the impairment loss of how much? Of 500,000. Then they are saying the impairment loss shall be allocated to reduce the carrying amount of the assets of the unit in the following order. Number one, you must reduce the carrying amount of any goodwill allocated to the CGU. How much was the goodwill allocated to the CGU? It was 380,000. Now, once you have allocated that, you are left with how much? 120 of the impairment, because our overall impairment is 500,000. And then allocate the remaining impairment loss to the other assets of the other assets of the unit, pro rata on the basis of their carrying amount of each asset in the unit. This reduction recognized as an individual asset, right? In allocating an impairment loss, you must make sure, meaning that when you allocate the remainder of the impairment loss within these individual assets, in this case, it will be that 120. In allocating an impairment loss, you must make sure that you don't reduce the carrying amount of an asset below the highest of its fair value less cost to sell. So in the exam condition, they will give you the fair value of those individual assets. And they will also give you the value in use. Make sure that when you impair those assets, you keep track of what is their fair value less cost to sell. And then you keep track of what is their value in use. So you must make sure that when you allocate that impairment, make sure that you don't reduce the carrying amount of that asset at that time when you do the impairment to the highest of these two. So if you know that actually when you allocate the impairment to the carrying amount, it's going reduce the carrying amount of an asset below the highest. So make sure that the carrying amount, when you reduce it, it doesn't go below the highest of the two. If it goes below the highest of the two, then you must limit it. Then the remainder again, you allocate it to the other assets. So you'll see my example. So overall, we have an impairment of 500,000. Now this impairment of 500,000, check how I'm doing it. I'm saying here, allocation of impairment. Total impairment amount is 500,000. First, I'm impairing the goodwill. I've impaired the goodwill because remember my goodwill was 380. So now it means I've impaired the goodwill fully. How much I'm left with? I'm left with the remaining impairment of 120. So this impairment of 120, I must pro rata it, allocate it within the other assets of the cash generating unit. But before you do that, do this exercise in the exam. Check all these assets that are listed here. Which ones are scoped in within IS36? Machinery is scoped in. You see, Sibongile, you see what I'm doing here. Machinery is scoped in. Intangible asset is scoped in. Motor vehicle truck is scoped in. Inventories are scoped out. You see, receivables are scoped out. I didn't include those. So it means this 120 that you have, you're gonna allocate it within these three assets only. Because the mistake you'll do in the exam when you allocate this 120, you will allocate it within inventories, you'll allocate it within the receivable. Then what does that mean? You apply the principle incorrectly, because in terms of IS36, inventories and receivables are scoped out of IS36. Remember guys, receivables are part of financial instruments. So they are under IFRS 9. So if you go up here, under scoped out, you see, if you come here, what is scoped in is that, and then what is scoped out? It's inventories, IS2 is scoped out. Financial assets, this Receivables falls under here, IFRS 9. So it's scoped out. So I've excluded it here when I was doing my payment. So now check this one out. Now they've given you that the fair value less cost to sell of the machinery is this much, value in use is this much. Which one is the highest? The highest is this one. Similarly here, the highest is that. Similarly here, the highest is that. So make sure when you allocate this impairment of 120, that you don't allocate it, you don't reduce the carrying amount, this carrying amount you don't reduce it to the lowest, to the highest of this. You must check that. So you see what I'm doing here when I'm pro-ratering. What I did, I took the carrying amount of machinery. There we go. Check it there. There. You see, it's 300,000. I took that. I took the intangible assets. I took the motor vehicle, but I excluded the inventories and receivables. So the total that I have is 900,000. Then I calculated what is my pro rata. My pro rata for machinery is 33%. For intangible assets is 22%. For motor vehicle truck is 44%. It means of this 120, I'm going to allocate 33% to the machinery. I'm going to allocate 22% to intangible assets. I'm going to allocate motor vehicle truck 44%. So here's my impairment in total. I've allocated. Then what is my remaining carrying amount? It's 260 for the machinery. Let's go back and check. They are saying when you reduce the carrying amount after impairment, it shouldn't be, let's go and read again so that you understand. If I go there, they are saying a cash generating ECG with allocated goodwill. Sorry, it's not this part. I think it's that other one. Yeah, here. In allocating an impairment loss, you must make sure that you don't reduce the carrying amount of the asset below. So that carrying amount of an asset after you've allocated the impairment, it shouldn't be below the following. It's fair value less, the highest of the two. It's fair value less cost to sell, it's value in use. So the carrying amount of that asset shouldn't be below. The carrying amount of the asset, in allocating an impairment loss, you must make sure that you don't reduce the carrying amount of an asset below the highest of the two. So you see what I've done here. You see how much is my carrying amount? It's above that. It's not below. You see? So we still fine. If I've reduced this carrying amount, let's say after impairment, this was 250. You see already it's below the highest of the two. Then it means I will limit it to 250. Then it means I must do the pro rata again of the two remaining and allocate the impairment. But also I must make sure that being the case, I'm still sure that it's not below these two. Because you see here also here, the 173 impairment carrying amount is also above these 260. Similarly here, the 346 is above the highest, which is 330. So I'm still fine. So this is what I wanted to show you guys in this example. So in this case, a cash generating unit, it can be a subsidiary. In this case, this for me is a subsidiary. A subsidiary is a cash generating unit because it can generate its own cash. If the holding company acquires a subsidiary and a subsidiary exists independently, it's a cash generating unit. So for you to be able to impair the subsidiary, you take the assets, all the assets, you minus the liabilities, you get what we call the net asset value. Then from the net asset value, you compare it to the acquisition cost. Then you get the goodwill. From the goodwill, then you calculate, you check what is the recoverable amount of the whole subsidiary. It's 700,000. It means you have an impairment. Then you impair based on the carrying amount. Our impairment is actually how much is 500,000. Then first I hit the goodwill, which is what I've done. After the goodwill, I have a remaining impairment. Then I allocate the remaining to the individual assets. But the principle you must remember, make sure that when you reduce the carrying amount of the individual asset, it doesn't exceed. It should be higher than the highest of the two, the fair value less cost to sell or the value in use. So this is what I wanted to show you guys in as far as the cash generating unit is concerned, because I think you can deal with the other individual assets. They are very simple. The complex one was the cash generating unit. So in an exam condition, you can have a scenario like this. So you should be able to do the impairment. This is how, here what I was trying to do is to showcase what the standard is saying. This pro rata thing is this thing here, that what I've done here, right? And then also what you need to know, which is key, you need to know which assets are scoped in, which ones are scoped out. Because in the exam, they're not gonna tell you. They're just gonna throw everything in there. And then you must be able to see which ones are scoped in IS36 and then which ones are scoped out. Because the ones which are scoped out, you must take them out. You don't impair those, because those have got their own standard where like inventory is carried at the law, of course, on net realizable value. So you can see already that impairment is taken into account. So are you guys happy with this example? Are you guys comfortable? Can I move on to Sibongile's example? Because the time I see is running away. Any questions with this CGU? Are you guys fine? Remember, this is not the only example of a CGU. A CGU can be anything. It can be an associate, it can be a bakery, it can be a pizza company, it can be anything, as long as it's able to generate its own cash flows. Any questions? Can I move on? Bongile? Can I move on? You give me a permission to move on?
Yes, it's fine, sir.
You're fine, I can move on, eh?
Yes.
Are you guys comfortable with this example that I've just done for the CGU? Moses?
Yeah, yes, it's fine.
Yeah. You understand what is a CGU now, ne? Because in IS36, they are specific to tell you what is the CGU. So what I've just done now, I've made an example of what exactly you can expect in an exam as a CGU. So you must be able to impair the CGU. And based on those procedures that you have followed, first you hit the goodwill. From the goodwill, the remainder of the impairment, then you hit the individual assets. But when you hit the individual assets, make sure that you know which ones are scoped in and which ones are scoped out. You see? So yeah, okay, guys, for the sake of time, let me move on to the example that Sibongile wanted me to do. Let's go through the question right first before we go to the solutions. Ne? So they are saying Smart Security Limited, a listed company, provides civilian security services in South Africa and in neighboring countries. So they are basically rendering services of security, civilians, right? The profit before tax of Smart Security for the year ended 31 December 2020 amounted to 2486750, including the following items. So it means these items below are included in this profit here. So take that into account. You have foreign income received from Namibia, dividends received from unlisted investment. Also, when you read in an exam condition, guys, remember one thing. When you read these things, they are telling you something. Like this foreign income received from Namibia. Foreign income received from Namibia, this might be exempt, but you'll see when we go along there. Dividends received from unlisted investment, it's local dividends. And you know local dividends are exempt. So it means they are rolling inside this 2486. So you might say that if they ask you to calculate taxable income, you might have to subtract them because they are exempt in as far as tax is concerned. For accounting, yes, you must include them, but for tax purposes, they're exempt. Expenses, depreciation, administration, building. In this case, you have an administration building. Normally, SARS doesn't give you a deduction for administration building, so you might have a permanent differences there. Depreciation drones, you have drones here. So here's the depreciation for drones. Credit losses, you have losses, 50,000. Offsite data backup services. Offsite data backup services. Okay, we'll see what is that. Fines paid to the Metro Police. For tax purposes, what you must think of here, fines are exempt. So the chances are that because you have deducted them from that profit there, you must then add them back, you see? So these are the things you need to remember because they've given you these things deliberately so that they will, after reading the question, they will ask you questions. Remember that you need to add things, subtract things for a certain reason. Smart Security received income from Namibia for security services rendered, which is not taxable in South Africa. You see, this income We have included it in that 2.4 million, but they are saying to you it's not taxable in South Africa in terms of the double taxation agreement. So it means that it was taxed in Namibia, so then it can be taxed in South Africa. So it means for tax purposes, you must subtract from the 2.4.
Sir,
Hello?
yes, based on the CGU, the one you did, the goodwill, was it given or you had to calculate the goodwill?
I calculated it. It wasn't given. I calculated it for you.
So when we're doing the cash generating units, we have to calculate the total impairment before we split it off where the impairment will be given.
Yes. You have to calculate the impairment. But because you guys, I was told that you didn't do a business combination. That happened. An example for, sorry, is it you? I think there's noise there. Can you hear me?
Yes.
I was told that you didn't do business combination. So I'm guessing, should it happen that in a worst case scenario, your lecturer gave you an example of a cash generating unit, the chances are that he might give you the goodwill. He might have calculated it for you because already you might not know how to calculate goodwill. So they might just give it to you, right? You don't have to calculate it because you don't know how to calculate it. I've calculated it for you because I thought maybe you guys did business combination. You see?
Okay.
Yeah. So
then the pro rata, the rates that you calculated, because I was trying to do them on my own. It's your you took your impairment amount, or is it the fair value less cost to sell divided by the total value of the asset?
No. The pro rata amount is the carrying amount, right? So what you do, remember I have identified the assets that you scoped in and scoped out. The ones which
Yes.
in.
Oh no, I get it now.
Yeah,
so it's the percentage of it's
you
the
add,
asset.
You add all of them, then you apportion them.
Oh, okay.
Yeah, then you'll get the percentage of the total.
Then that's the percentage we use to get the portion of the impairment for that asset.
Yes, 100%. But
Okay,
remember now, when you allocate that impairment, make sure that the allocation, the carrying amount, it's not, you don't impair, meaning the carrying amount should be higher than the higher of fair value less cost to sell or value in use.
Yes.
If it's below, you limit it to the highest of the fair value less cost to sell or value in use. So what we have smart foreign income received from Namibia. They are saying Smart Security Limited received income from Namibia for security services rendered, which is not taxable in South Africa in terms of the double taxation agreement. So in our income there, 2.4 million, we've included the income from Namibia. So we need to subtract it. Should we be asked to calculate taxable income, we must subtract that income because it's not taxable in South Africa. Smart Security Limited paid 15% foreign tax on this foreign income received, right? So property, plant, and equipment. On January 2018, Smart Security Limited acquired an administration built property to be used as the company's head office for 2.3 million, land being 500, and then 1.8 being the building. On acquisition date, the building was available for use as intended by management. On acquisition date, a residual value of nil and a useful life of 20 years were allocated to the building. Depreciation on the building is accounted for in accordance with the straight line method over the estimated useful life of the building. The SA Revenue Service does not allow a tax allowance on the administration building. What does that mean, guys? If SARS doesn't give you a deduction for an asset, would you calculate deferred tax? Tembil, would you calculate deferred tax if SARS doesn't give you deduction? You remember the lecture that we had for deferred tax when we define what is a tax base. Tembile, are you there? Okay, I will ask Yolanda. Yolanda?
No, you won't.
You won't. You know why? Because you're not going to get any future deductions, right? So you have a permanent difference. You understand? Because remember, when you calculate deferred tax, you take the carrying amount, right, minus tax base. So in this case, the tax base is 0. And then you're going to get temporary differences. Those temporary differences are called permanent differences because they're not going to reverse out. They can only reverse out if SARS give you deduction. You see? So what does that mean? It means that when you calculate taxable income, you're gonna show them as permanent differences. You see? But you'll see when we do the example. Let's move on. Okay, where was I? SA Revenue Service does not allow a tax allowance on the administration building. So administration property is accounted for using the cost model. Okay, so we are told we are using a cost model. A cost model is cost minus accumulated depreciation and impairment. Drones, on the 30th of June 2019. Also, what is our year end, guys? I forgot to mention our year end there on top, because when you read the question, you must always expect things. And then our year end is 31 December. And then check when did you buy these things, the drones? You bought them last year, June. So when you calculate depreciation, you see you're going to have a depreciation for half a year. You see, on the 30th of June 2019, Smart Security Limited purchased 3 drones, which are used to perform civilian security services for 90,000 each. So each of them was 90,000. So in total, probably they're somewhere around, I don't know, 2 something. On this date, the drones were available for use. So it means on the 30th of June, you must start depreciation as intended by management and also brought into use. So also for tax purposes, you're gonna start calculating allowances on this date. On acquisition date, a residual value of the nil was allocated. So there's no residual value to the drones, and the useful life of the drones were estimated to be 4 years. So for drones, it's 4 years, the estimated useful life. The accounting policy of Smart Security Limited stipulates that drones are depreciated according to the straight line method over their estimated useful life, right? The SA Revenue Service allows a tax allowance on the drones over 5 years. Oh, Spongin, you remember the question you asked me the other day? I think specifically the reason why you wanted me to do this question, it was these questions that you were asking. You remember you said that
Yes.
you saw a question where they did some pro rata for allowance, ne?
Yes, sir.
Let's read this question. You see what they are saying here? They are saying SA Revenue Service allows a tax allowance on the drones over 5 years. You see, pro rata, they are telling you pro rata according to the straight line method. So it means you must apportion. And accordingly, in terms of Section 11 of the Income Tax Act, I think you pro rata, if I still remember very well. I'll double check for you. But the other sections for SARS, normally they don't pro rata. In this case, they were very specific. They told you that they pro rata according to the straight line method. So that's why it was apportioned. You understand now, ne?
Yes, sir.
Yeah. So in that case, the other example that we did previously, we were never told that we're supposed to pro rata. So if we are not being told to pro rata, you don't pro rata. And according to the way, if my memory serves me right, is that for Section 11E, you normally pro rata. But for the other sections, I don't want to feed you the wrong information, but what I remember is that for the other sections, you don't pro rata. So it's because of Section 11E here, right? And then on the 2nd of January 2020, Smart Security Limited sold one of the drones. When was this? Beginning of the current period. So one of the drones only stayed for half a year. Then we sold it. Right? Details of the sales transaction, which can assume to be correct, are as follows. So there was the cost price of 90,000, selling price of 95,000, right? Carrying amount at 31 December of 750, tax base 31 December of 81,000. So we have sold this asset, right? So now, somewhere we need to calculate profit and loss, right? And by the way, did they say that this information we are reading is included in the above? It's just I didn't read that part. Additional information. Okay, let's continue. So now we know that we have sold the drone. The sale of the above drone has not been recorded yet in the accounting record. You see, already that profit that you saw there on top of 2.5 million, 2.4 million, we haven't taken into account the profit on sale of the drone. So we still need to calculate profit on sale of the drone. Is at 31 December. The carrying amount of the remaining 2 drones, which can assume to be correct on the 31 December. So in this case, they've given you the carrying amount. You don't have to calculate the carrying amount, even though myself, I did calculate it, but you don't have to. Remember, they've given you this carrying amount for a reason, for you to calculate deferred tax. Allowances for credit losses. The balance of the allowance for credit losses in the statement of financial position of Smart Security on the respective date was as follows. 31 December 2019 is this much. 31 December 2020 is this much. And then actual credit losses incurred are written off directly to the statement of profit and loss and other comprehensive income. The actual one, they are written off directly in the statement of comprehensive income and not against the allowance for credit losses. The SA Revenue Service allowance allows 25% of the allowance for credit losses as a deduction for tax purposes. Okay. Offsite data backup services. On 28th of October 2020, Smart Security Limited entered into a 3-year contract with B Data Limited to provide offsite data backup services. The first annual installment of 12,000 was paid on the 25th of October 2020 for the period from 1 November 2020 up until 31 October 2020. Guys, what does this mean? What is our year end? Our year end is 31 December. We have paid 12,000 for 12 months. What does this mean? Because we're going to cover only 2 periods. 1 November to December, that's 2 periods. What will happen to the remainder of the 10 periods? We have a prepaid. So keep that in mind, that we have a prepaid. And when you calculate deferred tax, you need to calculate deferred tax on the prepaid. The total payment was recorded as an expense in the accounting records of Smart Security Limited for the year ended. So what they've done, they've included the total amount of 12,000 as a security expense. So because you know that a business, if it's in an accrual basis, you must recognize the portion that relates to that period. In this case, it's only 2 years. I mean, it's only 2 months, so you must exclude the 10 months. So this is what you need to remember. Taxation, the SA normal tax rate changed from 29% in 2019 to 28% in 2020. So there was a rate change at the end. The capital gains tax inclusion rate is 80%. The tax assessment for the 2019 financial year showed an assessed loss of 250. So we have an assessed loss that comes from prior of 250, which is in agreement with the accounting records of Smart Security Limited. Smart Security Limited made the following provisional tax payments for the year ended 31 December, which was not yet recorded in the financial records of Smart Security. You see what these guys have done? They've made a payment in July or 31 July, including interest. So there was a penalty for probably paying late of 13,000. So in this penalty, remember, it's not deductible. So when you calculate taxable income, you must add it back. So 373, and then 31 December, they paid 180. So overall, they've paid 553. But remember now, in the exam scenario, you might be asked to calculate the taxable income. Then overall taxable income, once you gotten the amount, you multiply it by the tax rate, then you'll see how much you are owing. Then you minus whatever that you have paid. The remainder, it will be the payable amount to SARS if it's more than what you have already paid. So remember those things. Deferred tax is provided for on and all temporary differences using the statement of financial approach. There are no other exempt or temporary differences except those mentioned in the question. There is certainty beyond reasonable doubt that the company will have sufficient taxable profit in the future against which any deductible temporary differences can be utilized. The deferred tax asset balance on 31. This is a deferred tax asset balance, which meaning last year the opening balance, meaning opening balance 2020 would have been 107,083, which you may assume to be correct, right? They say ignore the VAT implication of value-added tax, VAT. So you ignore the VAT. Assumptions assume all amounts are material. So now let's look at the requirement. The first one, they're saying discuss the deferred tax implication, if any, relating to the administration property in the annual financial statements of Smart Security Limited for the year ended 31 December, right? So now what I will do, I'll take out this, just keep this question with you guys, because I want to put in the solutions so that we can all go through the solutions and see how they came to those amounts or the explanation. So now I'm gonna present this item here. So now what we have here as a first question, part A, they are saying, let me just go to the discuss the deferred tax implications, if any, relating to the administration property in the annual financial statements of Smart Security Limited for the year ended 31 December 2020. So now if you look at what I've done the administration buildings as follows. I said the carrying amount is 1.8. The tax base is 0 because SAS doesn't give you deduction. So you don't have any amounts that will be deductible in future. So hence it's 0. Now we have a temporary difference of 1.8. Can you provide deferred tax on this temporary difference? No, because it's a permanent difference. So there is no deferred tax consequences. And if you look at the solution they're explaining to you, they're saying temporary differences, they mean this 1.8. Temporary differences that arises is exempt in terms of paragraph 15, subsection 12 of IS 12. You must go read that standard of income tax, because they are saying, because as it arises from the initial recognition of an asset in a transaction which is not a business combination, and at the time of the transaction affects neither accounting nor taxable profit or loss. So hence the deferred tax is therefore not recognized. So you don't recognize deferred tax. So I hope I've answered you on that. And I did explain earlier that we will never have a deferred tax consequence, because anyway, you're not gonna get any future deduction from SARS. So, because if you provide deferred tax, somehow this deferred tax must reverse. What is it going to reverse against if SARS doesn't give you deduction? It will keep on going up and up and up, and then without reversing. Because somewhere it needs to reverse. So if you're not getting any deduction from SARS, you can't provide it. So we've provided an answer with regard to number 1. Number B says, prepare the general journal entry to correctly record the provisional tax payment, including interest, in the accounting records of Smart Security Limited for the year ended 31 December 2020. So they want a journal here. Here's the journal, guys. You debit the interest, 13,000, and then supposed to take the 553, which is the total amount you paid, right? Minus that. Then you'll get how much is the, why is this thing doing this? So let me undo. So this minus that. I don't know why my formula is not working here. Otherwise, I'm gonna have to just type it. Oh, I see. How much was the total amount we paid? Let me just check there. Need to redo this one. 553. See, 553. Which is inclusive of the 373. What we need to do is to take the 553. So your channel, yeah, so it's correct, right? I don't know why I kept on saying it's wrong. It's correct. So you debit interest expense, then you can debit SA revenue service, and then you credit bank because you've paid that amount 553. So here's the journal that they want. These are the 3.5 marks that you get for passing that journal. In part C, obviously I didn't put a narration. You must always put a narration here. What is this journal all about? Maybe that half a mark is coming from the narration. So you must explain that it's a payment of a provisional tax, mid-year and year-end. Part C, they wanted you to calculate the correct profit before tax. So what I've done, I took the profit up there, the one they've given to us. How much it was? It was 2.4 million. Where is it? I just need to go to that profit. 2.486750. I took that profit. Guys, can you be able to see my slide? Ne? Are you able to see?
Yes.
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 So I took the profit before tax, the one they've given us in the scenario. I've subtracted the interest, because remember they said the interest was not taken into account, right? And the profit on sale, the way I've calculated, I took the 95 proceeds minus the carrying amount. So that would have been the profit on sale. Because remember, guys, this is the accounting profit. This is not a tax calculation. This is the accounting profit. So here's the profit that I've made. And then also what I did, because remember they said they included the 12,000 within this profit, and there was a prepaid element. So what I'm doing here, I'm taking out the prepaid element. I'm left with 2,000, which is accrued in the current period because we prepaid. So this 2,000 would have been related to the November and December. So that's why I'm taking out the 10,000. Also, I'm adding back the 10,000. Hello? Yes,
Can
yes.
you please explain your point there again for the offsite of backup services?
Okay. Okay, let's go and read it so that you understand. Yeah?
Yes.
Read it so that you understand. They are saying, on the 30th of October 2020, Smart Security Limited entered into a 3-year contract with Big Data Limited to provide offsite data backup service. The first annual installment is 12,000. Annual installment, meaning that this installment is for 12 months.
Oh, it's for the year. Okay.
For the year. It's 12,000 was paid on the 25th of October for the period from 1 November to 31 December 2021. Remember, this is for 1 year. But what is our year end? Our year end is 31 December 2020. You see? So when you count from November to December, it's how many months?
It's 2.
It's 2 months. So the 10 months, it falls beyond our period, right?
Yes.
So it means, and then what they've said the 12,000 is included in the profit on top there. You see? So what we must do, we must exclude the reason why I'm adding it back, the 10,000, it was because it was included here in this 12,2486.
Yes.
So the reason why I'm taking it out, what will remain is the 2,000, which falls within the period, because this is what we need to recognize in the current. You see that? Yeah? You guys understand? You understand, Bongile? Bongile, can I move on? You understand?
Yes, we do, sir. We can move on.
All right. Okay. So now let's move on to Part D. Part D says requirement. Part D says calculate the deferred tax balance in the statement of financial position of Smart Security Limited for the year ended 31 December 2020 using the statement of financial position approach, indicating your answer if the balance is a deferred tax asset or liability. Now let's look at this. I've included these because I don't know whether in the solution they included them, but I just included them just to see that there is no deferred tax. Administration building is exempt because you're not getting deduction from SARS. Similarly with this land component is exempt. Now, I've calculated, yes?
Can I stop you again?
No problem.
On the proceeds, the sale
Of drones.
of an asset, yes.
Yeah.
Because I saw on the memo it wasn't indicated as 250.
It wasn't? Yes, Bongile?
So
Yes, Bongile, continue.
yes, sir. Are we not supposed to only include the portion that is acceptable by SARS, the 20%?
No, wait, Sibongile. You must differentiate between the two. Remember here, we are calculating the accounting profit. We haven't yet calculated taxable income. So what we are doing here, we are calculating the accounting profit. You see? So you just take the proceeds minus the carrying amount. You understand?
Okay.
Eh? You'll see when we go down there. I think your question will be answered there.
Okay.
So let's move on, guys. The drones, ne? The drones, you see the drones. Okay, you understand on both these, the administration building and the land, that is exempt, right? And then the drones. We bought the drones, if I remember, June 2019. So because there were 3 of them, I've multiplied by 3. The total cost was 270. I provided depreciation for 6 months. I got to, meaning beginning of 2020, I got an amount of 236. Then SARS also was giving you a depreciation, but it's apportioned based on 6 months for 5 years. So also you had a tax base of 243. I calculated deferred tax on that. It was a deferred tax asset in this case because your deduction were more than the carrying amount of the asset. So you'll get the tax benefits. So what I did, I less the carrying amount that was sold. So I took one drone, which was sold with the carrying amount which they've given to us. And then also I've less the amount from SARS perspective being the tax base. So I calculated deferred tax on that movement. Then I got to the amount, the corrected amount as the remaining two drones on the 1st of January 2020. So I've subtracted the drone that was sold based the carrying amount and also the tax base. So I'm left with 2 drones that were not sold. So I calculated deferred tax on that as well. Then I calculated depreciation for the year because it's 3.5 years left in as far as accounting is concerned. But for tax, it's 4.5 because they were giving us for 5 years. So the depreciation on both sides, I got to, because this carrying amount they've already given you of 112, but I recalculated it. It was just for me to show you how they came to that amount. Similarly with the tax base. So here's my deferred tax, 3780 as at year end, right? Then what I did, I added the allowance for credit losses. So we have these allowances of 200,000, but SARS is giving us 25%. We are providing them fully, but SARS is giving us a 25%. So you have a temporary difference. Then I calculated the deferred tax on that, which is in this case it's an asset, right? And then prepaid expense is the one that comes from the prepaid Sibongile, the one that we paid, the amount that it falls under beyond our accounting period. So it will be sitting in our balance sheet as a prepaid expense, I think under receivables, something like that. So I provided deferred tax on that. In fact, next week, just remind me so that I can read you the definition of a tax base of a prepaid expense. Hence, it's 0 here, but I'll show you next week why it's 0. Then I got a tax there. So this is how they got to that deferred tax amount of this total. So that is a deferred tax asset, right? Then part E, they wanted you to calculate the current tax due to SARS, right? So now for us to calculate the current tax due to SARS, we must take the accounting profit that we have calculated up there, not the one that they've given us, the one that we've calculated because there was some adjustment that we had to make. The profit on sale, which was not taken into account here, the interest expense, which was not taken into account there, the prepaid. So we must take this. So we take this accounting profit now, the 2.5 million, and then we must minus the exempt differences. What are the exempt differences? The foreign income received from Namibia. It's a permanent difference because SARS will never tax it. Remember, guys, this 200,000 was rolling inside this 2.5 million because based on what they've explained earlier, they said it was included there. So we must subtract it because it's a permanent difference. It will never be taxed because of double tax, because of double taxation agreement. So it's a permanent difference. You must subtract it because it was included here. That's why we subtract it. Then this 100,000 dividends received from unlisted investment. Dividends, guys, if you want to understand the local dividends, go read, I think if I remember, it was section 10(1)(k) of the Income Tax Act. Go and read that section. It will tell you that local dividends are exempt. So the reason why they're exempt, let me explain to you. The reason why the company that is receiving the dividends, they are not being taxed, they are exempt, is because the company that had declared the dividends, they were taxed. And the tax was withholding tax. So the company or myself as an individual, if I receive a dividend, the reason why SARS will exempt it, won't tax it, is because SARS has already taxed it under the company that it had declared, because they've already paid a dividend tax in the form of withholding tax. So that is why from the company's perspective, it will be exempt, right? So that is why it's a permanent difference, because SARS can't tax you twice. SARS can't go and tax that entity that had declared the dividends and then again tax you on the same dividends that was taxed from the other company. So that's why it's exempt. But go read section 10(1)(k). But if you have a foreign dividend, you'll see that it will be taxed. So just remember that. Capital profit on sale of drone. I think this is what you were asking. So if you check here what I'm doing, I'm taking 95,000, right, which is the proceeds. I'm minusing the 90,000, which was the carrying amount, which was the total cost of the drone. So that difference there is not going to be taxed. So I'm multiplying it by the 20% portion of, because remember, when you calculate capital gains tax, 80% is going to be taxed. But the 20% is not being taxed. It's permanent difference in nature. So you take the proceeds minus the cost, then you multiply it by the 20%. What I'm doing here, I'm taking 100 minus 80%, being the inclusion rate for CGT. So the difference of 20% is the capital gain, which is not going to be taxed. So I'm including it here as a permanent difference, right? Then what I've included also as a permanent difference is and the reason why I'm subtracting this amount is because it was included as profit. So I'm taking it out. This one, it was an expense, I'm adding it back. Fines, Metropolis. I remember fines, Metropolis, if you go and read, I think it's section 11G of the Income Tax Act, it lists a lot of things there that are exempt. There won't be tax, something like that. I might be wrong, guys, but I'll do my homework and then I'll come back to you next week. Which sections you can read for tax, where they're talking about the fines that are exempt. So that you add it back, because the reason why you're adding it back is because in this profit here, it was subtracted before, so you must add it back. Similarly, with this interest paid provisional tax, it is exempt. I mean, SARS doesn't give you a deduction, so you must add it back as well because it was subtracted here under 2.5. You remember we subtracted it here on top when we calculated that profit. So we are adding it back. And then what else that is there? 90,000 depreciation administration. Depreciation administration, the reason why we are adding it back, remember we are not getting any allowances for that building. So the depreciation that we have subtracted here in 2.5 million, we must add it back. It's a permanent difference. So we got to this amount. Then movement in temporary differences. What we did here, I took this temporary differences here for these assets in total. Then I minus the opening balance of the deferred tax. I grossed it up to get what was the temporary difference amount. Then I subtracted the opening balance deferred tax. Opening balance assessed loss. Then it will give me what was my temporary differences. So the difference is called temporary differences, which are deductible, right? In this case, the reason why they are deductible is because they resulted in a deferred tax asset. So I'm adding them back.
Sir?
Yes?
Sir?
Yeah, but I'm listening, Spongile.
Yeah.
Yes? Yes, I'm listening, Spongile. Ask a question. Hello? Spongile?
Yes, sir. Ish, my connection is very bad.
Okay.
I lost you, sir, when you were on capital profit on the drone. How did we get to the 1,000?
Oh, okay. Let me go back and explain again. Now, can you hear me now, right?
Yes, I can.
Okay, Sibongile, you remember we sold the drones for 95,000, right?
Yes.
This is the proceeds. It's money that you have received for selling the drone. Ne?
Yes.
So what we are doing, we are taking that amount, the 95,000, we are minusing the cost, right?
Yes.
And it will give you, this cost is actually a base cost. In fact, let me put it this way. I'm taking proceeds net of 95,000. Remember, how do you calculate CGT? CGT, take the proceeds, right?
Yes.
What the base cost? Am I right?
Yes.
So this is what they've done. They've minus the base cost, and the base cost for the drone was 90,000. So you go to the capital gain of how much?
5,000.
5,000. This is not 900. So you go to the capital gain of 9,000. How much of this capital gain is included for tax to be taxed?
The 80%.
80%, right? So now, when we take 80% of the 5,000, it's 4,000, right? Right? Then this difference between the capital gain of 4,000, it means it's difference of a permanent nature, meaning that SARS is not going to tax you on this 1,000. You see?
Okay, I get it.
You get it, ne? So
Yes.
that's why we are separating it, because our profit, the one included here, it includes this 1,000. So we must take it out because it's not going to be taxed. Remember, now we are calculating tax. It's not accounting profit. You see?
Yes.
So
Yes.
that's we are separating. You happy, ne?
Yes, sir.
All right. So I was here on the temporary differences. On the temporary differences, what I did, I took the 153. The 153 being my temporary differences. These are my temporary differences. Let's see how I got to that. Well, it comes from checks. How did I get to that amount? So these temporary differences here, guys, I did calculate this amount. Yeah. So is the 13,500? The 150 and also the 10,000. It gives you that for 153. That 153, which is a temporary difference, as you can see there on top. What I'm doing, I'm taking that, right? Then I am taking that, I'm minusing the opening balance of the defected asset. But remember, this was a deferred tax, so we must gross it up because the 29% was applied at opening balance. You must gross it up so that you can get how much was the temporary difference. Then you minus the 250, which is the asset loss. Then that will give you the temporary difference. I'm putting it there. I'm adding it back. Then also taxable income. Then I'm getting the taxable income total. Then I'm bringing the asset loss as at the end of 250, right? Then I'm getting the taxable income of 209. Then from that 209, I'm calculating how much was the tax that I was supposed to pay at the end. Is 585. But don't forget one thing. I've already paid. I think I've made a mistake here. I've already paid 553, if I remember. Let's just go and check. Guys, can anyone check in your solution? Ne? Did they put the 540 or the 553? It's the 553 ne, in your solution.
So shouldn't it be the 540 because interest is already subtracted in the profit before tax?
No, just double check for me in your solution because my understanding.
Okay, sir.
Just check the solution. Anyone, guys, just give me feedback quickly because I'm of the view that it's supposed to be 553 because this is how much we have paid in total. Any takers, guys? Do you have the solutions with you? How much was the total? Is it 553, ne? Or should I just open my solution?
It's 540, sir.
540, ne?
Yes.
Okay, then the reason why it's 540 is because of that interest that you have already subtracted, right? So it
Yes.
means now you are owing SARS the total amount of 45,000. So you create a payable. And then how do you create a payable? You'll probably debit SARS payable, then credit taxation expense. Here's the journal, guys. Let me just give you the journal because I see they didn't give you the journal. You'll have something like this. Taxation expense, profit and loss. Then you'll have SARS credit, SARS payable, SARS payable of, so that's the amount that you are owing SARS. Because your current tax expense is this much. So you must still pay, you have already paid 540 plus that interest, so you still need to pay 45,000. So in your balance sheet, you'll have this thing in your, you have to create an additional payable of 580 that you still need to pay to SARS, and then you'll have an additional expense, tax expense of 458. So this is the journal you're gonna pass. Then they also part F also ask you to disclose the deferred tax note. Okay, I'm there now. So the part F, which was the last required, disclose the income tax expense note, including the tax rate reconciliation notes to the financial statements of Smart Security for the year ended 31 December 2020, according to the requirements of ISO. So basically what they've done here, they took the current tax expense, the one we've calculated, which is that amount there. They disclose it there, but they've shown also the deferred tax expense. So the deferred tax expense was the 42,980 minus the 107 opening balance and the 3693, right? Which is the rate change. So they've adjusted the rate change at the beginning of the year. The reason why they've subtracted it from 107, the rate change, is because we want to show it separate here. So what we are doing here, we are taking the deferred tax, we are taking the movement, guys. So what we are doing, we are taking this deferred tax, right? This 42,980, and then we are subtracting the opening balance of the deferred tax of 107, but we're taking out the rate change effect because we're going to show it separately. Then we're taking the movement. So that's what we are doing. Current tax, this is so much. Then the rate change effect is so much. And then the foreign tax was on the withholding tax, remember, of 15%. So we are also showing that here. And then that's the total amount of the tax of 69932. So this is what they wanted to see, guys. This is what we're supposed to show. Based on what I've explained from the beginning, based on part A and part up until part F, is there any other questions that, guys, you still have with this question? Or where you were stuck, you didn't know what was happening with this question? Ask me. I'm here. I've done the question. Bongile, did I answer all your questions?
Yes, because I was asking as you were going through. Yes.
Yeah, we are clear now, ne?
Yes.
So don't forget every time where you have a capital gains tax that you will have to have that permanent difference, ne?
Yes, because I thought maybe it's the same treatment as the proceeds.
No.
Yes, the sale of an asset.
But guys, to be honest with you, ne?
Yes.
I don't know, it's just I don't have access to the leg. I feel that there's something that he had left out here, ne? And what he had left out in the solution in as far as tax is concerned is the recoupment. Have you heard of the word recoupment?
Yes, we have, sir.
You know how to calculate recoupment? It's proceeds limited to the cost, right? Limited to the original cost, then minus the tax base. Ne? Let's see if we, or maybe the reason why you had left it he had left it out was because we didn't have a recoupment. But we're supposed to have a recoupment because remember, if you remember when you decide to sell an asset, you have changed. Remember, okay, guys, let me explain something. Yes, I realized lecture had left out something here. What we call the recoupment. I forgot the section, but I think it's section 8 something. So recoupment, if let's say initially when you buy an asset, you tell SARS that my intention is to use this asset for a certain period, then SARS also will allow you for deductions and whatsoever. Then subsequently, you change your intention. You decide to sell an asset. What SARS normally do, they recoup what they've given you as a deduction. You see? Then you're adding it back. So what was supposed to happen, you were supposed to calculate recoupment here. And how you calculate recoupment, you were supposed to take the proceeds limited to the cost less what I call tax base of an asset. And the tax base of an asset, in this case, let's see if it is. So if the proceeds was 95, limited to the cost is 90. So it will be 90. Then what was your tax base for this drone that you have sold? The tax base, you see how much it was? It was 81,000. That was the tax base. So you must then, when you calculate recoupment, you minus the tax base. So what I don't see in this solution is that it's supposed to be here, because when you calculate tax, you must have this recoupment. So this 9,000 was supposed to have been recouped. It's just I don't have access to the lecture, but I will ask the lecture. But I know that I remember my memory. I know that my forgetfulness works better than my memory. But on this one, I'm 100% sure. Next week I'll come with a section. I'll tell you which section. You were supposed to have this 9,000 as a recoupment, and then the way you're calculating it is you take the proceeds limited to the cost, you minus the tax base. This recoupment was supposed to be here as part of the tax calculation. I don't see it here as forming part of the solution. So I don't know whether maybe it was forgotten or what, but I'm 100% sure, guys. I'm sure of what I'm saying, because I know this thing is there. When you calculate taxable income, you must have the recoupment. If you change your intention, you were initially depreciating an asset, now you change your intention, you are selling it. SARS will normally recoup what he had given you as a deduction in the previous period. Then you must add it back. So that's what I didn't see on this question, which is what you need to know. Don't forget in the exam, you must always calculate, if there's an asset sale, you must always calculate this recoupment, because it will give you marks. And how many marks? Probably 3 marks. 1, 2, 3. 3 marks. That in this question, I don't see it being included. Right? Happy, ne? Are there any questions? In fact, sorry guys, this is supposed to come somewhere in the middle, or because we have already calculated the tax, it's supposed to come here. In fact, it's supposed to bring it here. Bring it somewhere here. This recoupment. Then you'll add it here. So this 134, it's gonna be that plus that. Then you calculate tax on that. Are there any other questions? And if I remember, guys, the recoupment, go to the tax section and I'll check for you, or I don't know if I can quickly Google the recoupment. It can tell me the section. Maybe I can give you the section now. Just hold. Let me Google it quickly for you. The recoupment section is section. Maybe go and read it and you'll see what I'm explaining. Why am I not connected? Go and read it. You'll see exactly what I'm doing there. Recoupment.
Doesn't it depend on the way that you calculate your movement in temporary differences? Because in this case, we have 2 options: to do it separately, one by one, like to do all the movement, or to do it this way that you did it, sir. Won't we include recoupment if you did it in the long step approach, where you include all your allowances and stuff.
When you include all your allowances and stuff, ne? Okay, maybe also from my side, guys, not to mislead you, ne? I'll do my homework, I'll come back to you. But I got the section for recoupment, ne? It's
Yes,
section
yes.
84, section 84, subsection 8, ne? So it's
Yes.
section, sorry, it's section 8 for subsection 8. So that's the recoupment that I'm talking about. Yeah. Thanks, Ngobile, for Sibongile for asking that. Ne? Let me go and do my homework. But I felt as if maybe the recoupment was supposed to have been included. But you might be right. You might be right. I'll do my homework and then I'll come back to you guys next week. Just remind me. Ne? Are you happy, ne?
Yes, sir.
Anyone? Any questions? Dineo? Yolanda, any questions? Did you guys do this assignment? Hello? Yolanda?
Yes, we did.
Are you guys happy?
Yes, we are happy.
Okay, I'm happy that you are happy. As long as you have clarified some things for you where you were not sure how they got in the other figures, at least I managed to explain to you guys so that you can understand.
Can I ask?
Yes.
For okay, I'm not sure if I'll be able to go up the page, but I would like to know with movement in temporary differences.
Yes.
So when we are doing the table, like the deferred tax table,
Yes.
could you please tell or could you please explain further as to what goes into the table, or how do we differentiate what needs to what we have to calculate deferred tax for? And also, could you please explain the, I think it's calculation of current tax, because like I understand that it's between, oh, I think it's the profit before tax. Yes, it's the profit before tax. Oh, it's part E, this one.
Yeah.
Yes, where there is exempt differences. Please explain as to what we minus and what we add.
Okay, guys, to be honest with you, ne, it depends on the exam. Sometimes you might be in a situation where you are given revenue straight. They haven't done anything. Then in that case, you will take the revenue, then you subtract all the expenses. In this case, you have to do some adjustment because they've already calculated the profit for you, including those adjustments. So for tax purposes, you need to know, because remember, tax is different from accounting. Like, for example, we've deducted this foreign income. We've included in the profit this foreign income. But for tax purposes, this foreign income is not taxable. But from our side, it's foreign income, it's part of revenue. We've included it. Hence, we are subtracting it. You see? Same with dividends. We've received dividends. We've recognized them in our income statement as dividends received. But SARS doesn't recognize these dividends. It's saying these dividends are exempt. So we've subtracted them. You see? So it depends on a question by question. So for me to be able to tell you which one is which to subtract and add, you're gonna have to apply your mind in the exam. Like, for example, these fines, if you look at these fines were subtracted from the accounting profit. But for tax, they are not taxable. They are not deductible. So you must add them back. You see? What was it? Yeah, Yolanda was asking a question. Did I answer your question, Yolanda?
Yeah, yes. I wanted to actually understand as to, okay, how do we apply that? Because yes, I understand that there's a difference between the tax and the accounting.
Yeah.
So we have to apply that.
Yes, yeah. So that is that. But let's say when Yolanda, they've given you revenue, and then they haven't yet done all these adjustments. You see? there will be no need for you to subtract these accounting profits, because you see, you've started directly with revenue. You didn't start with profit before tax. Because what is profit before tax? Profit before tax is revenue, cost of sales minus gross profit minus operating profit. Sorry, is revenue minus cost of sales. You get gross profit, you get operating profit, operating expenses. And then from operating expenses, when you subtract operating expenses, what do you get? Profit before tax, which is what they've done here, you see. But now, sometimes you get a tax calculation where they just give you straight revenue. So in that case, there will be no need for you to subtract this 200,000, because this 200,000, they would have told you to say that it's not included in the revenue. So you'll just ignore it for tax purposes, because you know that it's not part of revenue, you see. The same with these fines. Because they are not included in the operating expenses, you'll ignore them. The reason why you've taken them into account here by adding them back is because already they were rolling inside this profit before tax for accounting. So to correct that, so that you have a right amount for taxable income, you must add it back as if it was not supposed to be deducted, you see. So you need to be able to know those things in the exam condition. And sometimes it's difficult for me to actually tell you, because there are a lot of them. Some they will bring some other things which are not even part of the solution here, you see. So it's a matter of you educating yourself, reading the material, so that you will remember which ones, you see. Happiness? And
Yes.
then other question, I don't think I understood your other question with regard to deferred tax. I don't know, maybe if you can just rephrase that one again.
It's for the deferred tax.
Yeah.
When we are calculating deferred tax, what do we, like, how do we know? Okay, I think you did mention before, like during the class, that some things we will apply tax in future, and some we won't, like I think it was buildings or land.
Yes.
Yes.
You remember,
so
just to catch you, remember when we read the scenario? Let me just go back to the scenario for that administrative building, because your question can be answered by the scenario. In the scenario for administration property, let me read it for you. They said on 1 January 2018, Smart Secret Limited acquired administration property to be used as the company's head office, right? The total amount was 2.3 million, including land 500,000, building 1.8. On acquisition date, the building was available for use as intended by management. On acquisition date, the residual value was nil and the useful life was 20 years, and were allocated to the building. Depreciation on the building is accounted for in accordance with the straight line method over the estimated useful life of the building. The SA Revenue Service does not allow a tax allowance on an administration building. You remember I said that it was there in the scenario. What does that mean? It means SARS won't give you deduction on the property, meaning on the building. That being the case, it means you can't provide any deferred tax. Your question, I see, there's something that you are lacking. You are lacking the fact that you didn't attend that lecture. Because there I explained the tax bases, what are tax bases, that tax bases are amounts that are deductible in the future against the future economic benefits. So in this case, if the revenue service does not allow you a tax allowance, it means you won't have a tax base, you see. And if you won't have a tax base, it means that you'll have a temporary differences, but that temporary differences will be permanent in nature, because SARS won't give you any deduction in the future. So you can't provide deferred tax on that.
Yes.
But that lecture will help you. Just go through that lecture, that video, and Tate Kakesho will share with you. Go through that lecture and then see again next week if you're still not clear. If you're still not clear, let me know. I'll make a plan to make sure that you understand.
Okay.
Yeah. So guys, yeah, basically that is it from my side, unless there's any other questions that you guys still wanna raise.
Assessed losses. Don't they affect our deferred taxes?
Yes, they do. They do affect our deferred taxes.
How did you calculate it? Because looking at your solution there, I don't see the assessed loss there.
Remember, the assets loss was taken into account at the beginning of the year. You remember that 107?
Yes.
That 107 includes the assets loss. Ne?
Yes.
Yeah.
Well, cause we are given the deferred tax for the beginning of the year, we don't have to include it in our calculation here.
No. We do. We can include it. In fact, it was included. If you look at the record of the tax, ne? I don't know if you're following. You see that formula there. Can you see that formula?
Which one?
Can you see my slide here? The one, which one? I think is this one, the Excel one. Ne?
Yes.
Just look at this formula. You see what I'm doing here?
Yes.
This 4298. This 4298 is a deferred tax. You see, it's this one here that I've calculated here.
Yes.
For what? For the drones, for the allowance, credit losses, for prepaid expense, right? The total is that amount, right?
Yes.
And this 428, what I'm doing, I'm taking the 428, I'm subtracting the opening balance of 107,083. This opening balance of 107,023, it includes that 250 of the assets loss. You see? Then I'm grossing it up. I mean, sorry. If you check, for example, this 107, I'm subtracting the 36,993 because it's due to the rate change. This rate change, you see?
Yes.
Yeah, so that's what I'm doing. So this 107, it includes that 250 of the assets loss at the beginning of the year.
Are we not supposed to show that 107 as part of our deferred tax calculation?
We are, because this difference is because of that.
No, I mean there on the top, sir.
No, you can. It's the same thing I'm doing as Bongile. Or what I can do this. Because when I think you want it like this, right?
No, I thought maybe it will change our total deferred tax amount. The
No.
42, it wouldn't make any difference.
So remember, the deferred tax, it will change because when you take that, you minus the. Remember, the deferred tax as at the end is 4298, right?
Yes.
Yes, you are right. When we have to now disclose the deferred tax, it will be the difference between the two. And they had journals, I think. Ne? It will be that 107 minus 30, then you disclose the difference because they are both deferred tax assets. You are right. So what you're going to disclose in your balance sheet is going to be this 42980 minus the 107. The difference is what you're going to disclose in your balance sheet.
Okay.
Yeah, as a deferred tax asset. Ne?
Yes.
Ne?
Yes.
So guys, yeah, I think that is it from my side. Unless there's any other further questions.